Well, shares of homebuilder Lennar are soaring after beating on second quarter sales and profit. Our next guest says orders and stable pricing are among the factors that increase his bullishness on homebuilders. Let's bring in Joe Ahlersmeyer, equity research analyst for Deutsche Bank. Joe, thanks so much for making time for us today.
Thanks for having me, Jacqueline.
So what do you make of these expectations coming from Lennar? It sounds like, full steam ahead here when it comes to demand for new homes.
Yeah, absolutely. And let's put some context around this. We wrote a report in August that we called Navigating a Mid-Cycle Crisis. And many were ready to sort of call the end of the post-GFC housing cycle. But in our view, what we were going to see was starts pause as affordability hurt the home buyer. Demand was going to reset. Construction would continue based on backlogs of homes under construction. And then starts would reaccelerate as demand sort of reset and buyer expectations reset into 2023. And that throughout all of that, we would see stable pricing. That was met with a lot of pushback. We reiterated that view in January. And fast forward to the spring, we've now launched on the home builders themselves with an overall bullish call, again, on demand. This belief that the public home builders are well positioned to capitalize on that environment. And we added a stock-specific outlay that really favors builders with higher return prospects and growth prospects. And so despite the fact that we have a sell on Lennar, we're overall bullish on the overall home builders.
Yeah, why is it that you have a sell on Lennar?
Again, the stock-specific overlay, which we think is a unique part of our coverage. So a lot of people look at the home builders as a monolith. You hear people talking on TV about orders and home builders and what they're able to deliver. But these builders are actually very different. The business models can be very different. If they're a build-to-order builder versus a spec home builder, the geography overlay is also very different. So what we've tried to do here is insert an overlay around higher returns on inventory and higher book value growth, because ultimately these stocks trade off of their book value and their higher returns, which translate, of course, to earnings.
Can you give us a quick just sort of breakdown on how Lennar does compare in terms of some of those factors that you were talking about, geography and the sort of type of homes that they'd be building?
Sure. So when you think about the two largest home builders in the country, that's DR Horton and that's Lennar, they're nationally scaled. It's not so much that they participate in every market in the country or every state like a Walmart. We heard your earlier guest talking about Walmart. Mm-hmm. It's really about the top 50 MSAs, right? It's where the home building need is. And it's really what I'm talking about here is demand for home building comes from household formation, and it also comes from migration around the country. So if you've heard about the Smile States, if you've heard about migration to Arizona, Texas, Florida, cities in those states, they require new homes to be built. And so that's where the home builders have sort of set up shop. They've bought land, years in advance, and now they're building homes on it. So Lennar is definitely nationally scaled, similar to a Horton. They're also selling affordable homes relative to, say, a Toll Brothers that sells a custom or higher end home. And they also do a business model that is more of a spec nature, which means they're putting a slab in the ground, they're probably stick framing it, trying to get it to a certain stage of construction, and then selling it to a buyer that's going to make some limited choices to take that to a delivery.
Do you think that the higher mortgage rates would be benefiting them in the sense that people would be looking for that more affordable type of home, in this environment?
Yeah, absolutely, because price plays into the payment, right? But also so do mortgage rates. So it's a little bit of a double-edged sword where the more affordable end is also very rate sensitive. But what you've seen in recent quarters is the builders have said, we don't necessarily need to hold price and just sort of stand here and say, this is what we're going to charge for a home and hope that the demand is still there. That's similar to really what the existing home market is looking like right now. On the new home construction side, the builders have said, we're going to be rational sellers. We're going to accept slightly lower prices. We're going to incentivize the home buyer. We're going to buy down mortgage rates, help them get into the payment that they need. And it's going to help us with asset efficiency because we're going to be able to turn our inventory faster. So that business model and those choices around helping with affordability do actually benefit more at the entry level. So you've seen companies like DR Horton do that, Lennar, Pulte on some of their more entry level product and their spec product, and that's been very successful in sort of bridging them through this tough affordability time.
Doesn't that cost them a lot though, Joe, in terms of having to help people in, like you said?
Yeah, believe it or not, it's actually not as expensive as you would think. There's probably several hundred basis points of margin that come out of gross margin for a home builder to buy down the rate by about a point. But if you look at the gross margins of the home builders in recent years, they've had tremendous expansion in gross margin, really because they buy land in advance of selling homes on it. So say you buy land in 2018 or 2017, you underwrite that community at a certain home price. And so over time, during the pandemic, what has happened is home prices have risen, and that land cost has stayed fixed. And so their gross margins have actually expanded by far more than several hundred basis points, in some cases as much as 1,000 basis points. So in order to continue to move the volume through those communities, they're willing to take a few hundred basis points of hit, primarily because it's temporary, to keep those communities running.
Joe, so you've got to sell on Lennar. What home builders would you be eyeing right now as a buy?
So we like DR Horton, we like Pulte, we like Meritage. Specifically with DR Horton and Meritage, these are the most entry-level home builders, which may seem like a strange call during an affordability crunch, but we think everything we talked about with respect to higher turnover on the homes and inventory side, and also with respect to being able to buy down mortgage rates and incentivize the buyer, that's played out really well for DR Horton and Meritage. And we see not only book value growth and top line growth for DR Horton and Meritage, we also see them generating higher returns than they did before the pandemic with respect to their land strategy. Pulte, similar reasoning there, but the difference is there's a little bit of a difference in home buyer profile in that case, where you have a move-up buyer, you have an active adult buyer at Pulte, but they're still employing a spec strategy, which has helped their turns. But one thing that's very interesting to us right now is, people talk about buyers getting pushed into the new market. That's really a zero-sum game. If we have mortgage rates come back down, that's going to free up supply in the existing home market. That's going to free up the starter homes that those entry-level buyers would typically be buying. And it's actually just going to push those move-up buyers back into the new home market, where we think Pulte will be able to address that demand. If
the Federal Reserve ends up hiking twice more, which the dot plot that we saw yesterday points to that possibility, how does that affect things from your perspective, Joe?
Yeah, absolutely. Great question. And trying to figure out what the Fed's going to do, that's a little bit above my pay grade. But I do think what's important to recognize over the last 2 years is housing's resilience really comes from this idea that you have to live your life. A lot of what we're seeing is driven by household formation. It's not driven by speculative demand or loose credit like we saw in the previous cycle. This is real demand that's coming from new household formations. And there's only one way to address that demand, and that's through adding real tangible supply. Not supply meaning instead of 2 houses for sale on my block, there's going to be 10. I'm talking about new units that can actually act as a release for that demand. And so if the Fed continues to hike rates, perhaps that would be a little bit of a headwind to margins for the builders, but they're going to figure it out from a volume standpoint. And because they're focused on returns, we really think that they're positioned much differently this cycle, much better this cycle than in priors.